Neal, the interesting thing about this is the run of data seems to be going somewhat against market expectations that the Fed would have driven us into recession by now. What are we missing here? Is it that savings during the pandemic were just bigger and that's allowed the consumer to be a little stronger even as interest rates are going up here? Or is it a shortage of labor at the moment and the fact that so many people have voluntarily taken themselves off the jobs market? I mean, the JOLTS data, even though it showed a drop, still showed a very healthy level of vacancies for work here. So what are we misunderstanding about the resilience of the US economy?
Well, the pandemic, as you said, did increase the savings. So that is a factor. I think the bigger factor is the second point you made. There's still a lot of folks who are not in the coming back to the labor force. So the labor participation rate went up last month, but it is still well below, it's at 64%. It's still well below pre-pandemic levels. But the other thing I would just mention is if you look at history, you go back to 1979, 1980, when Paul Volcker was dealing with a huge inflationary situation. Dealing with trying to create a disinflationary environment takes a long time. It took over a year for the ratcheting up by Volcker to have a real impact on inflation and on prices. So this is not an easy thing. The market would like it to be. The market is kind of, when we had a couple of days this week where it traded up dramatically on the JOLTS data, that's based on hope as opposed to what's really going to drive the market. And I would mention the US dollar being strong. That really does affect a lot of multinational big companies in the United States, and it will affect earnings. And so I would expect the market to be going over the trajectory to be lower. And I think you might have some trading days around, let's say it's a lower number, 250 as opposed to 275 today on the non-farm payrolls. But I think ultimately you're going to see the market go lower because this takes a while to really create disinflation that the Jay Powell and the Fed is trying to achieve.
Neal, can we talk about the size of increases we're setting up for? Because we had a very wide dispersion on the dot plots for the latter years. And the market just somewhat confused. If we go high, we stay higher, we don't pivot at any point. What do you make of the terminal point now for rates and just how quickly the pivot will return?
Sure. So right now, the expectation is another 125 basis points. So 75 in November, 50 in December. And at that point, that's the debate. The debate is, will the Fed continue to ratchet up after that, or will it pause? My suspicion is it may pause a little bit, but the market is telling you, and I would agree, that you're not going to see, really any kind of softening until possibly Q4 2023 or 2024. I mean, it's like I said, it takes a while to really create a reaction. Of course, we're not in the same time period in terms of inflation as 1979, 1980, which I referenced earlier. But, inflation really is quite high. I mean, you're looking at, 8%, 7.4% on the PCE, 8% on the CPI. So it's going to take a bit of ratcheting up and then stasis for a bit.